Good evening, friends. In liquidation, that is the liquidation of a company, we used to discuss order of payment, order of payment of liabilities. That is when company is liquidated, assets will be disposed and liabilities will be settled in a particular order. What is that order of payment? First, if there is any legal expenses, we need to make payment for that. Then, if there is any liquidator remuneration, we need to make payment for that. Then, any liquidation expenses we need to incur. Then comes secured creditors having fixed charge. Then preferential creditors we need to make payment. Then secured creditors having floating charge we need to make payment. Then we need to make payment for unsecured creditors, that is non-preferential creditors. Then you need to make payment for preference shareholders, and finally you need to make payment for equity shareholders. So this is the order of payment. Now, as and when we get cash, when we meet all these expenses, when we come to this particular stage, that is secured creditors having floating charge, most of the problems when we work out, debenture holders will be assumed as floating charge. For debenture holders, interest on debenture, assume a scenario with some numbers we'll understand. Accounting year of the company is 1/4/16 to 31/3/17. Company pays interest on say 39 and 31st March every year. It is September and March every year. Suppose exactly company goes into liquidation on 39, for example. Possibly they could have paid interest, we assume. That is on 39 or 1 or 2 days later, if it happens, we could have paid interest for that particular first half year. But when company goes into liquidation, for example, on 1/1/2017, last interest they could have paid on 30th September. Then for this gap, that 3 months, interest might be accrued. It is not due. It is due only on 31st March. But even before 31st March, company went for liquidation. Now the question is, interest till liquidation, whether it should be paid or not. The answer is yes. It has to be paid, mandatory. That is, after making payment to all these stages, when you have cash, you need to pay the debenture holders having floating charge. Not only the principal amount, including interest till the date of liquidation, it has to be paid mandatorily. But when you make payment for all these stages, it is not going to happen in one day. You are going to make payment for all these people. It may take another, sometimes few months or years also to make payment to all these people. In such case, 39 to 1/1/17 it is mandatory. It should be paid, okay. If payment is made after 6 months or 1 year or 2 years, from 1/1/17 till the date of payment, whether interest will be paid or not. That is, after liquidation, but till payment, whether interest should be paid or not. Then you need to check whether company is solvent or insolvent. That is, the company is able to pay the debenture holders principal amount. Company is able to pay interest till the date of liquidation. Company is also able to pay all the unsecured non-preferential creditors. and company is left over with some cash, that is before making payment to preference shareholders, if they have some surplus cash, then the company is said to be solvent. If the company is not able to make payment to creditor even a single rupee, then company is said to be insolvent. That means after paying all the unsecured, that is still stage 7, payment is made and company is left over with at least 1 rupee to pay the preference shareholder, company is said to be solvent. If company is required to pay, for example, for non-preferential holders 100 rupees, company is having only 99 rupees, 1 rupee there is a shortage, still company is insolvent. That is only when they are able to absorb all the unsecured non-preferential, company is said to be solvent. So if company is solvent, then you need to pay interest. When you need to pay interest? After floating charge, that is principal plus interest till liquidation plus unsecured non-preferential, but before making payment to preference shareholder, you need to pay that interest. If company is insolvent, then interest is not required. Sorry? After unsecured creditors, we should have some surplus. Some surplus. That surplus from which only you can pay interest, that is till the date of payment. Even 1 rupee also you need to make payment to them only. You cannot pay to preference shareholder. That surplus sometimes it need not match with the interest which you are required to pay, but still the available cash should be given to them. It should not be given to preference shareholder. But when company is insolvent, that is when we are not at all able to satisfy the outsider, that is unsecured creditors, non-preferential, then no interest after liquidation. Till liquidation it has to be paid. After liquidation, no interest to be paid. Then when we come back to this particular place, that is first we are making payment to the principal plus interest till liquidation, mandatory. Then we are making payment for unsecured non-preferential. Then any surplus left over, we need to pay interest. Then balance will be available for preference shareholder. Now when we come to this stage, that is preference shareholder stage, what about dividend? That is dividend after liquidation, it is not required or it will not be paid. There is no concept of dividend after liquidation. In fact, what normally people will understand dividend after liquidation means, whatever it is given towards settlement of capital only, they will treat it as dividend. So when company is a going concern, dividend means whatever it is given out of profits to the shareholders, they will call it as dividend. When company is a gone concern, dividend means whatever it is repaid, that is capital repaid, they will call it as dividend. So there is no share of profit distribution dividend after liquidation. But till liquidation, what is the position of dividend? Like till liquidation, what is the position of interest? Compulsorily it has to be paid. But here dividend, two possibilities are there. Check whether dividend is declared or not declared. In general, when equity is declared, preference I need to give. So when it is declared, it becomes a liability. Once dividend is declared, it is a liability. So what you need to do, that declared dividend, if it is not paid, you need to pay it in 7th stage itself. It is not in 8th stage you need to pay, because it is a liability. Till this stage it is a liability. But the condition is that you need to make payment to all other unsecured non-preferential creditors, including the interest for the debenture holders till the date of payment. Then dividend can be paid. Say they will be paid in 7th stage itself, but in 7th stage they will be standing last in the queue. That is only after payment of debenture interest, if required, then only you can pay dividend. But it won't be paid in 8th stage, it will be paid in 7th stage itself, provided it is declared it is a liability. When it is not declared, then you need to see whether the share is preference share or equity share. If it is equity share and dividend is not declared, do we need to worry? You need not worry, ignore. If it is preference share and if it is not declared, there will be a problem. What is the problem? There are two types of preference share we have. One is cumulative preference share, non-cumulative preference share. So what is the feature of cumulative preference share? So if it is not paid in a particular year, it will get accumulated and it will be paid in the subsequent year. Non-cumulative preference share, if it is not paid in a particular year, it will lapse. So next year when payment is made, it will be paid only for that particular year. There is no concept of arrears in case of preference share. Now, suppose if question is silent, in question they are giving preference share, 10% preference share. They are not mentioning whether it is cumulative or non-cumulative. Then normally, academically, we will always assume whatever chapter we try, preference shares are always cumulative. So whenever question is silent, even when we try AS number 20 also, earnings per share, there also we will assume preference shares are always cumulative. It is only an assumption. If it is specifically given in the problem non-cumulative, we can take that. Then, if it is non-cumulative preference share also, you can ignore when it is not declared. When it is not declared, you can ignore. But cumulative preference share, what happens? It is like you need to pay, but you need to pay not as a liability. It is like a arrear you need to pay now. But that arrear dividend, when it will be paid? Say now we are in stage number 8. That is, you need to make payment for preference capital. So preference capital, when you make payment, when you are in stage 8, whether you should pay preference capital and arrears of dividend, then you will pay equity capital, or first you will pay preference capital, then you will pay equity capital, then if there is any surplus, will you pay the arrear? That is when this arrears of dividend should be done. Is it in stage 8 itself whether we should pay the arrear dividend, or stage 9 we need to pay the arrear dividend? Stage. So whenever we think about preference shareholder, why they are called as preference shareholder? So they have a preferential right to get two things. One, when company is going concern, they have a right to get dividend even before giving to equity shareholders. When company is a gone concern, even before repaying equity shareholders, they have a right to share capital. When company is going concern, before giving dividend to equity, they have a right to get dividend. When company is a gone concern, that is liquidated, before returning capital to equity, they have a right to get their capital. Now, when a company is a gone concern, before giving equity capital, you should pay preference capital. Whether arrears to be paid in between? Dividend should be paid when going concern assumption exists, before equity dividend, preference dividend. Gone concern before capital, preference capital. But gone concern before equity capital, arrears of dividend to be given, it is not told. So normally what we need to do is that first you need to pay for preference capital, then you pay for equity capital, then if there is any surplus left over, you need to pay for arrears. After payment of arrears, still if there is any surplus, normally that surplus will go to equity people. But if articles of association permits, that is AOS permitting the company to pay arrears of preference dividend in case of liquidation even before returning equity capital, then first you can pay the preference capital, second you can pay the arrears, then you can pay equity capital, then you will have surplus. If AOA, sorry, why? No, equity capital to the extent of capital given by them, not. I am not finishing this particular part. If AOA does not permit, then first preference capital, then you need to pay equity capital or equity share capital, then equity capital only to the extent of that paid up value, then you can pay the arrears, then surplus will be there. This surplus normally it goes only to equity shareholders, but if preference shareholders are participating preference shareholders, then a portion will go to preference shareholders, balance will go to equity shareholders. So what is the order of payment? Sorry, academically that portion will be given in the problem, but if question is silent, normally that surplus will be distributed in capital ratio. Whenever you try, say in CA final, there is a chapter called as valuation of goodwill and share. In that valuation chapter of, that is valuation of share, they will be asking question, find out the value of a preference share. And also they will ask, find out the value of the preference share if they are participating preference share. In the problem, they will give information for surplus also. So that surplus, how it will be shared in one problem in exam, they will give, you can take that share. 1/3 will be shared by preference shareholder. Then if that 1/3 or 1/4, those information, if it is not given, then you will assume it is shared in capital ratio. So what is it you need to understand is that there is no concept of dividend after liquidation, but interest after liquidation depends upon whether company is solvent or not. Here, whether company is solvent or insolvent, there is no question of dividend after liquidation. But till liquidation, you can check whether it is declared or not declared. If it is declared, it should be paid as a liability. This won't be paid in stage 8 or 9. This will be paid in stage 7 itself. But only making payment to all other people, you need to make payment for this. If it is not declared, see whether it is a preference share or equity. Equity you can ignore simply. Preference share, see whether it is cumulative or non-cumulative. If question is silent, you should take it as cumulative. Non-cumulative, specifically told, you can ignore that dividend. Then cumulative, whether AO is permitting the company to pay arrears even before returning equity, or AO is not permitting. If AO is permitting, first preference capital, then arrear, then equity. Otherwise, first preference, then equity, then arrear. The surplus, whatever it is left over, first you can give for equity. Normally it goes entirely for equity. Suppose if preference shares are participating preference shares, a portion will go to preference shareholder and balance will go to equity shareholders. Now, here also, if question is silent, whether AO is permitting or AO is not permitting, what stand we need to take? Most of the problems in exam, they will assume AO is permitting the company to pay arrears of dividend even before returning equity capital. So you should take this stand only. And next question, if question is silent regarding whether preference shares are participating or non-participating, always we will assume surplus will go to equity shareholder. To be precise, 3 assumptions we need to make whenever question is silent. That is, preference shares are always cumulative, preference shares are always non-participating, and AOA permits the company to pay arrears even before returning equity capital. These 3 assumptions what we are telling should be made only when question is silent. If question specifically says something, then you need to follow that instruction only. Whenever we say dividend, it includes dividend, equity and preference. But first it will be paid for preference, then it will be paid for equity. So Order of payment is very important. While doing that, you need to ensure whether all these things are there or not. So that is what we would like to tell. In case of interest, till liquidation, there is no second opinion. It should be paid compulsorily. But after liquidation, till payment depends upon whether company is solvent or not. But dividend, after liquidation till payment, there is no concept of dividend. But till liquidation, see whether it is declared or not declared, whether it is equity or preference, cumulative, non-cumulative, then AO is permitting or non-permitting, then finally whether it is participating or non-participating. All these things you need to make inquiry. Sorry? That is settlement to shareholder. So actually what happens in case of companies, whenever there is a problem for making payment to outsiders, when company is not having any cash, first they will make call from, that is shareholders will be referred as contributories. Since they are contributing to the company to make payment for outsiders, they are called as contributories. How we call in marginal costing as contribution, here they are contributories. But their liability is restricted only to the extent of unpaid amount per share. But when company is making call, first they will call from equity shareholders. When they are fully exhausted, they will call from preference shareholders. But when payment is made, first payment will be made to preference shareholder, then only payment will be made to equity shareholder. That is, when call is made by the company, first they will call from equity. If there is any risk, first it will be taken by equity, then it will be borne by preference if it is required. But when company is making payment, first it will be paid for preference, then only it will be paid for equity.